everyone, Jean-Christophe here. Welcome to this training. So in this training, I wanted to show you how we do a credit spread. So a credit spread is one of the most basic spread in options trading, and I think that's very, very important to know how to do it. So in this training, I'm going to show you how to do it. So this is the TastyWorks platform. It welcomes like US customers, like a lot of people, actually, a lot of countries. That's one of the only brokers, the only option trading brokers that accept, I think, as that many people from that many countries. So if you haven't registered like one account with TastyWorks, I definitely recommend you to do it. They have a platform that is quite easy, honestly, to manipulate, and yeah, I think that's a very, very cool platform. And as much as Thinkorswim is a great platform, but more I think for the user friendliness, I think TastyWorks has also done a great job as doing a platform like this. So let's get back to the point, the credit spread. So what basically we're trying to do is this. So this is a called credit spread that we're going to do. So the purpose of this, so this is like a profit and loss diagram. The purpose of this basically is to sell like one call. So basically you sell one call here and you buy you buy another call here. So that was a shitty B. So basically what you're going to do here when you're going to trade that that spread is that you're going to sell a call, and at a higher strike you're going to buy another call. So what is it going to do is it's going to give that diagram at expiration, meaning that basically what you're hoping for when you do a call credit spread is that you're hoping for the market to go down, except that if you were just selling a call options, you would go naked and you would have an unlimited risk. If you type on internet on Google like sell a call naked option, you're gonna see that the profit and loss diagram is you're gonna have this, which is basically the premium that you collect at expiration, and when it goes down after that, you're gonna see that it's an unlimited risk, which is not necessarily the best thing that you could do. I definitely suggest you not doing this. So what you can do is if you bearish basically and you want to sell like a call, but you don't want to have an unlimited risk, which can be completely understandable, you can do what we call a call credit spread. So a call credit spread, so as I said, you're going to sell one call at a certain strike and you're going to buy another call at another strike. So I definitely recommend you to go on the description of the group and download the guide that I've put in for free. So that's literally my training routine. So I literally show everything. I show the type of strategy that I use. I show which market scanner is great to scan stocks and ETFs. I show you how I exit trades. I mean, it's literally like a PDF, a 30-page PDF that I use every day. So it's definitely useful when you don't remember everything. Like you have absolutely all the strategies possible, how I trade, how to define your portfolio needs, create your watch list, choosing the strategy, when to exit the position. So, and for each direction, market direction, whether you're bullish, neutral, or bearish, you have strategies depending on the IV rank. So this is something I definitely recommend you to do, and it's available in the group description. So, and if you haven't joined the group, I definitely recommend you to do it so you can access this guide. It's completely free, and it's really to help you become better at options trading. So here we're basically focusing on the call credit spread. So how we do that, as it says here, it's sell one call, buy one call at a higher strike, and you can see that the risk is limited. So the risk is basically limited to the premium that you have to give when you buy that option. When you buy this option, basically, you're gonna have to pay a premium for that, and that's the maximum risk that this strategy is gonna be. And the reward is also limited because the reward is basically the premium that you collect when you sell that call option. So you're gonna receive a premium on that. That is the maximum reward you could get at expiration. So it's important to remember that those profit and loss diagrams are only at expiration. They're not like theoretical. I'm going to show that in the platform right away, but that's at expiration. So now let's go on the platform. So this is the TastyWorks platform, and when you go I'm going to take like the most liquid ETF on earth, the SPY. I'm going to open, this is the option chain, so you have all the expirations. I'm going to choose the expirations for May 15, And here it is. So you have all the strikes and everything. So if you are not familiar with this, no worries, I'll do some videos later about how to read an option chain, but the focus today is really to see how to make a credit spread. So basically the price right now is trading at 278.20, so that's why there is this orange line. This is the call, all of this is the call side, and all of this is the put side. So so this is all for the call and all for the put. And because like basically here is the call, you see that there is a small arrow that says in the money, because basically if you bought a call here, now your call is in the money, because now it's trading at 278. If you bought a call at 272, it's in the money. Here it's out the money. So basically how does that work? A credit spread is you're gonna have to sell a call at a certain price, at a certain strike, and buy a call at another strike higher. So how we choose the first strike to buy? Well, personally, I always like to choose the 70% out of the money strikes, because it gives you enough probability, and you pay in general quite a good price for them, for the option price. So what you do is that you click on bid, not build, sorry. And now you see that we have one leg that is done. It's the selling of the call. And when now we go onto the analysis, what we see is what I talked to you before, is that you have an unlimited risk. So you have the premium, the green zone is the profit, and now this is the risk. And you see that we have an unlimited risk, and that's what we don't want. That, so that's why we're doing a credit spread, which is basically we're gonna buy, let's say the 295, we're gonna buy a call at a higher strike. So you see that we sold the call at 292, at a strike of 292, and now we're buying a call at 295. What does that do now on the profit and loss diagram is that you see that now our risk is capped. It's capped with the premium that we actually pay when buying the call. That's why we buy that call after at a higher strike, because it gives us a risk that is limited to the premium that we pay. And that's how we build a credit spread. So basically what does that profit and loss diagram say is that if the price goes below 290 at expiration, we're gonna make our money, which is $116. However, if the price goes above 290, we are going to lose our premium, which is 184. And I think the very interesting thing is that you see that like there is a P&L theoretical here that is not the same as the P&L at expiration. So you see that the P&L at expiration shows the premium that we can lose at our maximum at expiration. So the question is, what is the P&L theoretical? And that is basically today, if you are in the credit spread position right now, how is your profit and loss? And basically, because the option pricing doesn't only depend on the underlying stock or ETF, it also depends on the time until expiration and the volatility, the implied volatility of the option. And those three factors are the major factors that are going to influence the profit and loss of a position. So that's why we have a difference in the profit and loss at expiration and the profit and loss theoretical now, because it refers to as today. So you see that today, for example, if the price were like you were opening that credit spread position, and the price were basically where it is right now, 278, you would have right now a P&L of $20. So you would be in a position with a gain, an unrealized gain of $20. And you see that at expiration, it would be 116. So now the question is, okay, but how do I know when am I going to reach those 116? Do I have to wait until expiration? So for that, TastyWorks has a great built-in tool that like in Thinkorswim, by the way, but basically they allow you to see the P&L theoretical, meaning as today, and to modify the date to see how that P&L would change. So let's say that, for example, we take 250. Today we would be at $87 unrealized gain. What happens if we go here and we basically change the date, we go forward in time? So let's say that now I choose I don't know, the 29th of April, we would see that at 250 now, on the 29th of April, it will be 106 at the same price, at the exact same price, 250. So you can see how time decay is going to have an impact on the option pricing. And it shows that it doesn't only rely on the movement of the underlying stock. And that's why sometimes, like, if you're beginning options trading right now and you're wondering why sometimes you have a maximum reward, which should be of, I don't know, like for example here 116, but you don't have that, and you're wondering what the fuck, basically. And that's because of the time decay and the volatility. So here we have the time that you can go forward. You have the theoretical spot price, and you also have the expiration implied volatility, meaning that takes all the strikes, and that takes the implied volatility, which is 42.03%, and we can modify this, and we can see how you can see that the curve of the P&L theoretical, so this one, you can see how when we modify the implied volatility, how that curve is gonna change, because that shows how the volatility is gonna modify the option pricing. Meaning that if there was a decrease in the implied volatility, you would make your profit a lot faster. You can see that now the P&L. If I'm coming back to today. As of today, if you were at 250, you would make your total profit if the implied volatility was at 7%. But it's not the case. Today it's at 42%, and you would make 88. But if the implied volatility were to go up, for example, you can see that your P&L as of today would not be 83 anymore. It would be around 56. So that shows how there are other factors or the major forces other than just the movement of the underlying stock, and that's how basically the price is your option price is gonna move. So now that you built your credit spread, you really have this risk and loss risk reward thing that you can directly see into the platform. And so to sum up, that's how you build a credit spread. So you can basically whether just like take one strike at regardless like where you want. Like it's up to you. Personally, I always like to choose the 70% out the money probability, because it shows that, for example, if you were putting a profit target at 50% of the net credit that you're basically receiving, you will have a 74% chance of reaching that profit target. So meaning that over 10 trades, like you would make like basically 7.4 trade winning and the rest in losers. And the losers basically are not going to be that big. The max loss would be 184, but there are ways to manage those losses and to reduce them. So that will be for another video. So this is how you can do a credit spread. You can just move everything around, and that's how you really build that figure. So this is it for today for this credit spread training. I hope that you enjoyed it. I hope that it enlightened you on some stuff maybe that you didn't know. And if you liked it, just don't hesitate to send me something, to tell me that you liked the video, and see you soon. Thank you very much.